Hello and welcome to another episode of the Real Estate Investing Club, the place investors go to learn tips, tricks, and stories from other investors in the field. Before I introduce today's guest, I have three short housekeeping items to cover. First, if you like our content, the best way to support us is simply to like, subscribe, comment, or share this episode with your friends and family. Second, we are active investors ourselves and are always on the lookout for mobile home, RV, mixed-use commercial, and multifamily properties in MSAs with a population of 100,000 or more. So if you are also an active investor and have something you think we may be interested in, we would love to take a look. Send us the details of the deal at www.therealestateinvestingclub.com. Third, if you are a new investor and would like to learn how to get started or scale your real estate investing business, go to www.therealestateinvestingclub.com to check out our course. So without further ado, let's dive right in. We have a very special guest with us today, so buckle up, grab your pen and paper, and enjoy the ride. All right, we are live. Bernard, thank you very much for joining us today. How you doing?
Doing great. Gabe, thanks so much for having me. I think it's a great time to get on a show about real estate investing. We're getting into Independence Day. It's all about freedom, and real estate is one of the great paths to get there.
I love it. I love it. To get us started, why don't you tell everybody, who you are, where you're from, and how you got started in real estate in the first place.
Let's do this. So I am a CPA, and I am based in New York, New York. And I know most people think CPA, they think about somebody, bean counter, filing taxes and pouring over IRS forms. And so while I certainly do some of that, that's definitely not what my primary focus is. My focus is in using more creative and substantive strategies. So it's really about digging deep, helping people with an array of strategies, whether that be 1031 exchange, qualified opportunity zones, self-directed retirement accounts. It's really taken a deep dive into different niche areas of tax law and entity structuring so we can really help people maximize their net wealth, which is really all about.
I love it. I love it. So, you weren't born into, you're a CPA now, you're an expert at what you do. It's not how you got started in life. So kind of how did you get into the field of real estate? CPAs, you guys are the, you're the superheroes of the real estate world because you save us money. So how did you really get into this world of real estate to begin with?
The path is quite interesting. CPAs, do an array of things. And we get called upon, and a lot of things that I did prior to launching my own business with its unique focus, helping people with so many different financial strategies. And what I kept seeing is that there's a huge world out there that's trying to sell people all sorts of financial products and not giving people all the information that they need to make the smartest choices, and really leaving out so many key tools that people can use. So it was about financial advisors. They're going to tell you all sorts of life insurance stuff or all sorts of heavily loaded funds with all sorts of expenses and not really do anything to change the trajectory of your life. But there's a world out there where you can take charge and you can really alter your life. But to do that, you've got to take responsibility for yourself and kind of grab the bull by the horns. And the best place to do that we can all access is real estate. And so I kind of said that world is a world that has very limited, and it doesn't even satisfy me professionally. I really want to help people and in a way that's really, really meaningful. So the first step that I took was to set up a service where we can help people actually take their retirement accounts and direct them to real estate. And we're the only firm that does that in a way that gives people the support and the guidance that they really need to do this. So we're not the only ones that help people with this, but the only ones that have that integrated tax expertise that help you avoid the little pitfalls that can be very expensive and also help you structure it in a way that will maximize the strategy. So the net difference to our clients can be millions of dollars. Whether we've helped them avoid a costly mistake or we've helped them structure things a little better, there's incredible value that we can add with our tax expertise in this self-directed retirement space.
Awesome. I love it. And yeah, I mean, you have your retirement fund, you have your retirement money. A lot of people that, the first thing they do is they just put it into the stock market because they're just not, they're not sure what to do with that money. They don't know where the best returns they'll be able to find. But I mean, if you go look back in history, real estate has had, anybody who's invested in real estate has had much better returns than putting that same amount into the stock market. And so real estate is, and as far as a return standpoint, it is a fantastic vehicle to build your wealth, to build your financial security into the future. So I love that you guys are helping people do that. I want to get into a little bit deeper into the tax side of things. I know people listening, watching, most people want to fall asleep when they hear taxes, but it is so important because it's just one of those things that will kind of bite you if you don't understand it properly. And real estate it's a great vehicle for tax savings. So kind of take us, what are the main ways that investing in real estate, especially through a retirement account, can help you from the tax perspective?
Yeah. So there are a whole lot of ways, and it'll vary depending how you're investing. And I would want to just address for a minute why real estate can be so much more attractive than the stock market. I'm very well versed in stock market, and I can share some resources with you about that. The thing about the stock market is it's been very conclusively proven that the money managers don't really add much value. So other than accepting fees out from you and shaving off 3% off your returns every year, which is a huge number, they're not really adding much value. And the reason for that is the stock market is accessible at the click of a button. And whether somebody is in New Zealand or South Africa or in Georgia, they've all got access. So we've got hundreds of millions of eyes on the stock market, and everybody's analyzing, everybody's trying to do something. You can't beat that. Everything's been analyzed to death. There's no opportunity there really left. It's all immediately taken away. Whereas in real estate is private. There's real opportunity there. Of course, somebody can make a bad move. But if you know the market, or you know somebody that knows the market, right, then you have real opportunity there because it's private. It's not a spectator sport. You can go in there and you can shape the facts in the ground. You can add value. With the stock, you just don't have that opportunity. So that's what makes real estate, that's why it can be life-changing, because you can actually create something, whereas in the stock market, your hands are completely tied. How does that sound?
No, I love it. I love it. Absolutely. I mean, that's one of the main reasons why I wanted to get in here as well, is because, it's one of the few things that you can do and actually see a result at the end, a physical result. When I was working in corporate, that was one of my biggest complaints, is that, there was no end result. I was working on things, but I never really got that satisfaction. But in real estate, you got to structure. There's something there that you can actually change, you can add value to. And that's kind of what brings the value up from the ground. So you guys really focus on helping people with their retirement funds, utilize their retirement funds the best. So kind of take us into that. If somebody did want to utilize their retirement fund in real estate, if they wanted to put it to work in the real estate sphere, do you suggest they go out and buy their own property? Do you suggest they go out and invest in a syndication, maybe a REIT? What's the best ways to go forward there?
Yeah, so it's really going to vary from investor to investor. So the first thing you really have to understand about every investor is their investor profile. Well, because suppose I say, hey, doing it this way is going to give you the best tax structure. But if they're the kind of investor that doesn't want to be involved with the toilets, boilers, roofs, right? So syndication is going to be the way to go. Even if, right, you don't want the taxes to dictate your life. Taxes, you want to manage them, you want to mitigate them, you want to optimize, but they don't drive your life. I know that may be surprising to hear from a CPA, but that's really, I think it's a mistake to make taxes the hyper focus. These are life choices. And again, when you talk about real estate, we're talking about that freedom, that flexibility. And then to go kind of say, I'm going to surrender some of my freedom so I can, deal with the IRS, that would be self-defeating. I know. How does that sound to you? I mean, I know some people always, the holy grail is to totally eliminate taxes. And I think the holy grail is to live the life that you want.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast. Yeah, I couldn't agree more. I mean, the purpose of working is a great way to be of service to your community. But when it comes to money, you don't want to just make decisions just to make more money because that's not life. Money is not life, and it's just an aspect of life. Especially taxes, you don't want to change your life just to save a few dollars in the tax area. But there are things that you can do.
Oh yes.
That don't include all of your time and effort to save money on the tax front. So kind of outside of the investing side, outside of using your retirement account, when it comes to taxes, I know that there are certain asset classes that have a better tax benefit.
Mm-hmm.
So kind of take us through the asset classes. I know single families, even buying just a regular single family house is a good tax. You can get great tax benefits from that in and of itself, but kind of take us through the different asset classes and how they have an impact on the tax side.
Yeah, let's do it. So real estate, for the most part, what the great benefit that you can get in real estate comes from a couple different areas. The first one is from your depreciation deductions. So depreciation tax deductions are non-cash expenses on a tax return. Now, I'm sure you know what that is, but I'll elaborate just a bit. So generally speaking, when somebody says, I've lost money, I've reported a loss in my tax return, that's nothing to get excited about. Yeah, you may have saved some taxes, but you lost a bundle. When you have depreciation expense, that's an expense that goes in a tax return, but doesn't actually cost you any money. So you can be cash flowing and still reporting a loss when you have depreciation expenses. And you have depreciation expenses when you have capital assets. So that means when you're investing, putting money into an asset, that asset gets depreciated. And to illustrate, so where do you have a business that has heavy capital assets? Real estate, right? Real estate is a capital asset. Improvements is a capital asset. So you're going to put all this money into the real estate. And if the deal is going well, you're going to be cash flowing. And beyond that, the value of your asset is going up. So you bought the asset for $1 million. It may now be worth $2 million. But guess what? You tell the IRS each year, I paid $1 million for this. Each year, I want to claim a portion of that as an expense, right? So you divide that $1 million over a certain number of years, and each year you get an expense in that amount. Now, that expense is not money out of your pocket. It's kind of allocating, it's taking the cost of the building and expensing it year by year. But the building has actually gone up in value, right? You're going to sell that for a gain, but each year you're saying, hey, I've got this expense. So depreciation is the first component of this.
And that's funny because I'm gonna keep going on this, keep your train of thought. But the one thing I was going to say is I never quite understood why real estate, there is this depreciation, because it is it's appreciating asset. It never really goes down in value unless you're in a really crappy area. But so I that was just kind of a side comment on my part, because I just didn't get it. I why is the IRS looking at real estate as a depreciating asset? It doesn't.
So I'll tell you. Okay, I'm glad to answer. It depends how much you want to nerd out on the taxes. But here's the explanation. In reality, right? What would be even better than depreciation is the year you bought the asset, you paid $1 million for it, claim $1 million expense, right? You spent $1 million, you had $1 million in your bank account, and now that $1 million is gone, right? So how about had an expense, right?
Yep.
You have an expense in your business, it's a current year expense. But what the IRS says is that no, you can't claim that full expense up front because you had a transfer. It's more like you moved $1 million from cash into another asset. So
Okay.
it's there. So anytime, even if you buy equipment for your business, right, what you do is you allocate the cost over the life of the asset. So you say you think this asset's going to last a certain amount of years. Okay, so each year you claim a little bit of the cost of that asset rather than taking it all up front. So real estate is the same thing. And the IRS has said, listen, we can't let people determine. Can you imagine what we'd have if the IRS would say, how long do you think this is going to last? All right, I think my boiler is going to last 2 years. I'm going to claim the expense over 2 years. And somebody else says it's going to last. So the IRS came and said, all right, we just have to come up with some artificial, arbitrary periods for each item. So residential real estate, we'll call that 27 and a half years. Commercial real estate, 39 years. Exactly. And so ironically,
why didn't they do something? Yeah. Why didn't they do something, an even number? I never, like 29, 7.5 years. What the hell is that?
Yes.
Who came up with that?
And one thing that I'm sure you know about is cost segregation. So there are assets that you can do 5, 15, right? Because actually, I don't know if you're able to see in the link who introduced me to you. Because we should give him credit.
I didn't. Was it Yona?
Oh, it was Yona.
I love it.
Okay, yeah. So let's give Yona the credit. And Yona, what cost segregation is all about, right? It's great to depreciate things over 27 years. But how about if you can claim it all in year one, right? That's called using bonus depreciation. Or certain things you can do over 15 or 20 years as opposed to 27 years. So that's what cost segregation is about, is moving all that forward and trying to take as much as possible of it up front. So this is one area, this world of depreciation, which by now you must have a recording about this already.
yeah, we've done cost segregation. It's pretty good.
So that's the first aspect of it. It's the depreciation. And now let's move on to the next step of that, because it really is, it flows. It's really logical. So remember, now we've got this asset you bought for $1 million, and now it's worth $2 million. You're depreciating it. You're claiming all those expenses, but you've now got, it's worth $2 million. Your equity is now up, right? Maybe when you got into the asset, let's just use round, easy numbers. You had 25% equity in the deal, but now it's worth $1 million. Now your equity is 1.25 million, right? So normally, if you want to recognize, all right, you want to eat it. So you want to recognize some of that equity. With most assets, all right, if you got something as that, if you want to recognize some of that, you can sell it. But what happens when you sell it? Pay taxes. With real estate, there are a couple different strategies, right? You can go to the bank and do a refi, right? And you can take money out and move that into other deals, right? And you're going to get new tax deductions for the interest that you're paying on the loan. And loan money, debt, is not income, right? So now you pull the equity out, still no taxes. So you kind of got the benefit of the appreciation without paying any taxes. Alternatively,
that's the beauty of refining, right?
That's right. You refi, you pull your money out, you kind of get the benefits of the sale without the taxes. Alternatively, say you want to exit, then you can go to do a 1031 exchange, which is now available only for real estate. So you can get the benefit of that $2 million, of that new equity, that $1 million of equity, leverage that into new assets, and pay no taxes. How are we going? How's it sounding so far?
Sounds fantastic. I love it.
So, Gabe, you want to invest in real estate?
I'm signing up. Where do I sign? Awesome. And so that you went over two things there. You said three. Was there a third one, or was that
so the whole bunch of stuff? I'm trying to follow a logical train. So we started depreciation. That's always a starting point. And then from there we went to leveraging the equity without paying taxes.
Mm-hmm.
And you can do that through 1031 exchange or refi.
Mm-hmm.
And then obviously we can take it a step further. We can talk a bit about real estate professional. Am I familiar with that terminology?
A real estate professional, or
so in the tax realm? Maybe
no, I'm not actually.
Okay. So here's the deal. Real estate ends up being very tax efficient as an asset class.
Okay.
Right. So you can have an asset that's appreciating, generating cash flow, and you're showing negative taxable income.
Okay.
Right. But now the question then becomes, all right, this is great in of itself. I've got this asset. I'm making money, no taxes. But that loss, can I take that loss actually and use it to offset some other income that I've got? I've got income somewhere else. Maybe I've got a W-2. I've got a job. I've got a small business. And can I take that loss and net it on my tax return and tell the IRS, hey guys, real estate, there's no taxable income there. But not only that, I'm going to show you guys a big loss on my real estate that's really profitable. And then I'm going to take that profitable loss and I'm going to net it against my W-2 or against my business. And now I owe you guys nothing. Can you do that?
Okay, I'm following.
So that's going to depend on whether somebody is a real estate professional for tax purposes. So Congress, way back in the 80s, realized that, hey, we have all these high net worth people that are investing in real estate to create all these so-called losses, right? So people were buying, people that were ultra high net worth people and, very high earners, medical professionals, sort of financial professionals, earning lots and lots of money in their jobs and their businesses, and then buying some real estate just to create these losses because the loss itself was incredibly valuable. Forget the returns on the real estate. We just want to buy losses. So because every dollar of so-called loss saves them 50 cents on their taxes in their business. So they put in rules in place that to limit the ability to take real estate losses and use it to offset active income.
Interesting.
But,
okay.
The real estate industry, came out what was up in arms about this, right? Because say somebody is a real estate agent, all right, and they generate income, they get commissions, and they also will naturally invest in real estate, right? And these people were saying, hey, I'm not this doctor that really is in the medical profession and is kind of doing this real estate thing to create losses. Real estate is my business. Right. And I should be entitled to take those losses from that side of my real estate business and offset income that I've got on the other side of my real estate business. I am in the real estate business. And so about a year later, Congress acquiesced and they put into the laws that if you're a real estate professional, and a real estate professional doesn't mean it's not a certification that you get. It's defined by the tax code. Then you can use those losses to offset active income. So if you have commissions.
Yep.
If you've got acquisition
wholesale fees. Yep.
Oh, exactly. You got it. So if you've got that kind of active kind of income, you can take your losses from your rental property and offset the income that you would have that would kind of be what we would call Schedule C income. So you get a Schedule E loss because your real estate is going on Schedule E. You get that loss, and then you can net it against the income that you're showing on your Schedule C or your W-2.
Gotcha.
How often do you ever look at your tax return?
Zero. I've never looked at that thing.
Okay. So in tax speak, Schedule C is shorthand for business income. Okay. And Schedule E is shorthand for rental income. So whether that be a rental, a duplex that you bought, or it's something that you invested in a larger asset, with a couple of other people or syndication, that's rental income. So that we're talking Schedule E, which is going to be rental or income from partnerships. And Schedule C is kind of your own business income.
Gotcha. Awesome. So you're saying, so the third benefit is you can use, being a real estate professional, you can use the active income that you produce there. So for all the wholesalers out there, all the brokers, all the agents, people who are actively making money in the real estate field, they can use that to offset, or they can use their rental income to offset the active income
rental loss, right? The losses that we're getting on their properties, right? Again, profitable losses, cash flowing losses. They can use that to net against their other sources of active income. So this is kind of I think there's a fairly good overview. And one of the things I like to emphasize to people is that you really, when you enter into any financial, tax, investing space, you need to be working with people that are able to understand the breadth and depth of what you're doing and how that relates to the tax space. We started this conversation with self-directed retirement accounts, but you can see we're talking all about taxes and general real estate tax. And people really need to optimize what they do with their overall tax profile. And so on the self-directed space, we are the only ones that are able to really guide people to the best structure for them. Because when they come to us, we understand their entire tax and financial profile. And this way we can help them choose what's going to be best for them.
I love it. And my parents just recently went through their entire retirement planning. There's a whole thing that goes into it. And I would not recommend anybody do that on their own. They definitely need to bring in a professional like Bernard and his company. And especially when you have a sizable amount of money that you need to put to work in your retirement to give you that safe net to live off of into your golden years. You want a professional in your corner who's going to be who knows the right way to go about putting that to work in the real estate sphere. So I love that you brought all that up. And just to go over real quick, the three benefits for taxes: you got depreciation. You can leverage equity with your refi and your 1031 exchange, and then real estate professional. You can offset your active income as a real estate professional. Just to give everybody a real quick overview, I know if this isn't your expertise, there's a reason you hire people like Bernard, because this guy is an expert. He knows what he's talking about. So Bernard, I want to move on a little bit. We try to keep these episodes around 30 minutes. So we're closing in on the end here. Before I do, though, I always like to ask people. I didn't ask in the beginning. Do you invest in real estate yourself? Do you purchase properties yourself? Or
so I absolutely do, but I do it as a debt investor. I tend to sit behind the desk. Notes. And I say kudos to those people that are, actually make the deals happen. But I'm buried in tax law and financial stuff, and I lend against real estate. I love doing that. And I think everybody that's in the real estate space has to be aware of that, whether you're raising capital or you're, looking to deploy capital. There's so many different ways, so many avenues. Yes, you can be an equity participant, benefit from the upside, unlimited upside potentially. But of course, there is the potential for downside. Or you can be a debt investor, which is, the route that I've taken. Your upside is capped.
Yep.
Your upside is capped, but so is your downside. Worst case scenario, you walk away with an asset.
And for those of you who are not familiar with debt investing, basically it's buying a note, a mortgage on an existing property out there. So it's definitely a great. I haven't had anybody on the show who's done that, so I kind of wish I knew that before, because I could ask you a few questions about that one too.
There's a lot to talk about, and that's the beautiful thing when you step into this space, is that there are just so many roads and so many avenues. Within equity, there are so many structures. Within debt, there are multiple structures. You can kind of, when you talk about syndicating and you talk about buying your single family, in debt, there's the same thing. You can lend money. You say, I know you. I trust you. And we can be efficient, and I'll just give you, all right, you want to flip that triplex? I'll give you the money for the rehab, or I'll lend you the money, the equity portion, get the rest from the bank. There are so many different ways to do it.
Exactly. She stole the words from my mouth. And that's one of the reasons that I love real estate so much, is that creativity abounds. There's so many different ways to invest. And then once you choose that avenue, there's different ways to go about doing that. So if you want to do single family, multifamily, commercial, what have you, there's different ways to go about investing in those different asset classes. And if you don't even want to invest in structures, you just want to deal on the debt side of things, on the note side of things, you can also go about that. So, for those of you who are not yet, I know there are some people listening and watching who do not, who haven't really, pulled the trigger. They haven't really started investing. Just do it. Just pull the trigger. The more time you wait, the more experience you miss out on. So, awesome. Well, Bernard, thank you very much for coming on. Before we do close out, I always ask everybody the same question. If you were to go back, to the Bernard who started on this road, however many years ago, 10 years ago, and tell him just one piece of advice going forward, what would that be?
I think that piece of advice is to find, not to hesitate, connect with people. It's really about opening up yourself personally, psychologically, mentally. Be open to the opportunities. Don't be too guarded. Of course, you have to protect yourself. And maybe, I'm not sure, some of the other questions you may be throwing at me may talk about a little about due diligence that you've got to do. But the overwhelming flow and sentiment's got to be that you're open to the world, open to opportunity, open to connecting, because you can't do it all yourself. And when you try to carry that burden on your own, it's self-limiting and self-defeating. Connect with people, network. You're going to broaden your own expertise. You're going to broaden the opportunities, and you're just going to get 1,000 times further.
I love it. That is a great, nobody said that, Johan. That one yet. I think it's a great piece of advice. Open yourself. Many people talk about networking, but one of the keys to networking is being open, being transparent, letting people know that you're here for them just like they're here for you. So thank you for that piece of advice. So you've given us a lot on this show already. You've shared a lot of pieces of wisdom on how to invest your own self-directed IRA and how to go about doing the benefits of taxes in the real estate sphere. But we all need to receive things as well. So if somebody were to bring you something, what would you want to receive?
It's not, I'd say what I really enjoy is interacting with people that have the same mindset as I do. So let's say in business, right? So a primary focus of mine is financial, tax, and particularly the self-directed retirement account space. And there's a lot of nuance to all of this. And the people that I connect with best are the people that appreciate nuance and appreciate integrity. And that's the most rewarding thing. It's just, this morning I had a call with somebody where, we're setting up his retirement account. He's going to be putting the money into syndication. But we talked for an hour and a half about all the different structures that we can set up for him, what's going to work best for him. And I don't view that as like, okay, all right, this guy's on the phone. He's already paid the fee. Now let's just make this call as short as possible because, hey, there's no more money to be made here. And I know I loved every minute of the discussion because he's the kind of inquisitive person that wants to do the best thing and recognizes that there are a lot of ways to do things, and he wants to be educated and do it right.
Awesome. I love it. So on that note, if somebody did want to get in contact with you, what would be the best way for them to do that?
Okay. I tell people sometimes you provide contact info. I like to say you can Google my name, Bernard Reisz, and you'll find lots of substantive resources. You can Google, and that's Bernard, Bernard Reisz. You can Google Reisz LLC, Reisz Financial. But for those that want, you can send me a direct email. That's bernard@reiszfinancial.com.
Awesome. There you go. And I will also put Bernard's LinkedIn URL in the show notes. So if you want to just reach out to him on LinkedIn, you can just go click through down below in the show notes. Again, Bernard, thank you very much for coming on and sharing everything that you've shared. For everybody listening and watching, I appreciate you guys joining us today, and we look forward to having you guys on the next episode.
Awesome. Gabe, thanks so much for having me.
Thank you for joining us on the Real Estate Investing Club. If you feel we provided value, we would appreciate it if you hit that thumbs up, share it with your friends online, whatever it may be. If you'd like to share or partner with us on an investment deal, we are always looking for quality projects. Go to www.therealestateinvestingclub.com to get in contact with one of our partners. Otherwise, I hope you guys have an absolutely fantastic day, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.